Hey everyone, welcome to Dr. Frank's Finance World. I am Dr. Frank the Bank, where I try to teach you something about finance so you can make more money. This is a fun part of the lesson plan stuff we're working on here called Finding the Assets. Got some interesting, unique sites to go to give you some ideas on what you might want to do to find new investments. So, anyway, check out the books in our bookstore. There's some links here at the end, and it's pretty good stuff. So, to get the day started, I look at it from a really big picture when it's all said and done. And these are the sites that I typically go to. I go to CNBC, they at least have some good information. Then I go to Trading Day, which is pretty fascinating, NASDAQ and NASDAQ.com. So let's see what that looks like. Well, the pre-market stuff, if you're getting it from uh, basically from CNBC out here, it does give you interesting what's happening within our markets. You can also come down and see what's happening in the Asia Pacific theater or in Europe, as well as commodities and currencies. Get some big picture of what's happening with the day. They also have volatility that they're measuring different ways, different areas, oil and so forth around the world. Get a rundown of the treasuries to see how big the inversion is right now, for instance, and then just U.S. indexes and sort of a breakdown of whether it's transportation or utilities or see which parts of the sectors are winning and who are losing the battle. So trading day I like because it lets you put in somebody like we'll go to Microsoft here in a second. You can look at big picture about what's happening with the economy and the labor market and that kind of stuff, and some bats before and after trading and see what's happening before and after hours. But when you click in a company like Microsoft, for instance, you see all the different places you can go to, whether it's Barron's or Bloomberg or Market Watch, some pretty good ones, Morningstar, Reuters, Seeking Alpha, and so forth. You can also look at after hours and before hours trading on them as well. You can go to the company websites, see what insiders are doing, management and so forth, competitors. You can look at the charts and so forth out there and look at 5-year and 10-year charts on them out there in Zacks, which does really good accounting work, for instance. Anyway, you can click on a lot of these and get just a ton of help and background on a company you might be interested in all on one page, which I think is pretty cool. Another one is go to NASDAQ, and all I did was put in Walmart and pull this up, and it pulls up like this. You can see real time what's happening. Once again, the before and after market hours trades and so forth, longer periods of time. News, press releases. You look at dividends and historical quotes and financials and earnings and some of the ratios and option chains. If you want to stay up on the options, another place other than Yahoo to look at that, Yahoo Finance. And then, short interest, which is kind of interesting, as well as the SEC filings, give some basic sort of data on what's happening with the company and the PE ratio and so forth at the time, looking forward for 1 year, what that would be, and so forth. So it's just really interesting places to go to collect data on the morning to see what's happening out there. So when finding assets, I would highly, highly, highly recommend that you check out Pat Dorsey's books. It's one of the ones in our bookstore on Dr. Frank's Finance World up there. But it really does read like a handbook of investing. It gives you some great ideas and things like, don't swing for the fences or make sure that they have a defendable advantage over other companies and just a tons of interesting information and what it means when the CFO or the CEO leaves and whether you want to hold on or not. So really smart guy and some really good ideas there as far as finding assets. All right, so you also want to look at historical, what's going on out there. I look at value versus growth. That's always been the fight that's been going on forever and ever and ever out there. A lot of people want to know, well, what is a value stock? That's a good question. And actually, I've got a pretty good answer for you. There is a value stock screen on something called valueexplorer.com. But it pulls up a bunch of different companies and what industry they're in and all the rest. Pulls up some Graham and Greenblatt. They were value guys and what they would score them based on theirs and so forth. But if you look over here, I think you get a pretty good idea as well. You're looking at If we expand these enterprise value to sales, or enterprise value to EBITDA, or price to earnings, or earnings per share growth, sales growth, price to book, return on equity, dividend yield. Those are the type of things that when you go screen inside of FinViz, that's what you would be looking for a value company out there. So it's just a pretty good starting place. For growth, it's a little different. And let me see if I go back to this. Yeah, we talked a long time in the 80s and 90s about something called growth at a reasonable price. And that's where PEG ratio and that kind of stuff comes in. But the reality is, I took that a little bit further when I had the newsletter that I used to sell at the last university that I gave the money to the school for kids to travel. But at any rate, here's what I looked at there that when I was considering growth. So you can see a bunch of companies I was tracking down here: Apple and Broadcom and Caterpillar and Express Scripts and a bunch of those. I just pulled up one here on Altera, whatever. It's just one of the smoking guys, cigarette guys. But at any rate, you can see it's pretty old information out there. But I liked it for a lot of different reasons. The earnings growth rate was positive. It was actually pretty high. You're talking about an 18.65% earnings growth rate, which is very solid. The revenue growth rate was still double digit, which is good. It's less than the earnings growth rate. When the revenue is growing slower than the earnings, it actually indicates increased efficiency for the firm, because somewhere between revenue and net income, they had to get more efficient to bring more of it to the bottom line. They paid a dividend, but it was really small, and the payout ratio was negligible, 4%. So there wasn't any risk. Whenever they pay a good dividend, I want to make sure I think they're not going to cut it. That's what I'm looking at. They had no debt, so debt to equity ratio was great. It had a higher beta than you'd expect. A lot of times you never get a beta of 1.5. 2.26 is pretty high, especially recently. It's higher than it was over the long term when I did this report. The stock will be more volatile, but I can live with that. The market cap for Altria at the time was pretty small, which is great, right? Less than $1 billion is small cap, 1 to 10 billion is mid cap, but it's perfect range for growth and safety. It really is. The price to earnings ratio was 19.97. Forward, trailing was 22.1, about equal to the market, but the market didn't have the growth prospects, so you were paying less for earnings than you were if you were to buy the S&P 500. The PEG ratio, which is the price to earnings scale by growth, was less than 2, which means that's good. That's the number you're looking for, according to Peter Lynch. The market to book was 4.5 times, which is less than what the market was trading at the book value, so it was kind of cheap from a book value. It was trading in the middle of the range, kind of a neutral on that. It had underperformed the S&P, so regression to the mean suggests it might overperform over the midterm or so out there. Then this is just when we had bought and sold it lately. Return from July until when I did this was up 32%, which is outstanding for a stock that has more or less traded flat. The probability up and down, I ran Z-scores on that based on where it was in the cycle. Had a lot better chance of going up. In other words, Bollinger Bands, it was down towards the bottom. And it did what I expected it to do, which is something I called well-behaved. It basically worked well with technical analysis. Anyway, a lot of stuff going on now out there and so forth, but it was a leader in the field and it looked like it was going to do well. So when I'm looking for growth, those are some of the things that I'm looking for growth-wise out there. It looks like it's Altera, a chip manufacturing company. So anywho, that is how I look at kind of the growth side of the equation. How is it doing, and how is it doing relative to the S&P and the NASDAQ and ones like that. So special topic, this is kind of a fun, it's a freebie I throw in there. One place you can go that's pretty fun if you want to test your own strategies out there is a place called The Collective. You can also do StockTrack. Both of them are resources on the Dr. Frank's Finance World, but let's see what The Collective looks like. So it looks like this. And basically there are 50,000 different people who have put their strategies on there, and they track it for you. And if your strategy does really well, you might actually have people who will attach their portfolios to your real world strategy and pay you for it, which is kind of cool. Not a ton of it connected, but it's gotten better over the years out there. And you can see different strategies as they come through here, and whether they're stocks or futures or whatever out there. It's just pretty interesting stuff. You can stop and look at it if you want, but anyway, there's it's some of them done pretty well. I mean, 41% a year since 2018 is actually a pretty good return when it's all said and done. So you can kind of go in there and mess around and see what they do. You can't see exactly what they do, but it is pretty interesting to have people do that. So there's how it works. You put yours in, they track it. If somebody likes it, they invest their money, and you get a little something off of it. Anyway, I had never seen anything like that before, so just kind of fun. So, all right, that's the part one of the assets. The book I would do is just go back to Intelligent Investor. Benjamin Graham has some great long-term ideas about investing, value ideas especially. Pat Dorsey is the man when it comes to recent stuff. We are not looking at research this time on this one, and you need to consider value versus growth every single time, because sometimes value is going to be the way to go. Sometimes growth. Value is a little safer in down markets. But relative to the risk traits and the economy / market, your risk traits, you might consider all in one, all in the other, or a combination. But I think it's something to consider every time I form a portfolio. I'm trying to find assets. So don't forget to send emails and comments and ask Dr. Frank so we can put together a group of those questions as well. Have a great day. Thanks. Catch you later. Bye bye.